You put down $200 and suddenly you're controlling $10,000 worth of stock. No bank loan, no debt. And if the stock moves the way you predicted, that tiny $200 can explode into something much bigger. Sounds like a dream, right? Here's the part nobody tells you. You can be right about the stock and still lose your money. And it gets stranger. There are 3 invisible forces inside that $200 trade. The first one works against you while you wait. The second one plays with your decisions. But the third one, that's the one most beginners don't even realize is there until their $200 is gone. And once you understand what's really happening inside that contract, you'll never look at a $200 options trade the same way again. Imagine controlling $10,000 worth of high-performing assets for a single $200 bill. You don't take on debt. You don't ask a bank for a loan. If the asset surges, you capture the gain like a heavy investor. If it collapses, your loss stops right at that initial $200. It sounds like a secret backroom deal, but it's one of the oldest financial tools in the market. It's called an option. Today we're going to pull back the curtain on how this contract actually works, the psychological traps hidden inside it, and the invisible forces that can eat away at a beginner's account long before expiration day. Let's skip the confusing market jargon for a moment. Imagine an art collector eyeing an emerging painter's canvas priced at $10,000. The collector isn't completely sure if the art world will embrace this piece next month, but he doesn't want another buyer to snatch it. So he hands the gallery owner a non-refundable $200 fee. In exchange, the owner gives him a legal agreement, the right to buy that painting for $10,000 anytime within the next 30 days. Now imagine something changes. A famous critic praises the artist. Suddenly, everyone wants the painting. Its value shoots to $30,000. Our collector can still buy it for his locked-in price of $10,000. But what if the opposite happens? The artist gets forgotten. The market turns cold. The painting is now worth $5,000. Our collector doesn't have to buy it. He simply walks away. He loses the $200 fee, but he doesn't have to spend another $10,000 on something now worth $5,000. That $200 fee is similar to what options traders call the premium. The locked-in price is the strike price, and that 30-day window is the expiration date. Now, every option contract comes in one of 2 basic flavors. A call option gives you the right to buy an asset at the strike price. A put option gives you the right to sell an asset at the strike price. That's the foundation. Now let's follow an investor named David. A technology company is trading at $100 per share. David buys a call option with a $100 strike price, expiring in 1 month. The premium costs him $200. Remember, one standard option contract generally represents 100 shares, so David has exposure to $10,000 worth of stock. That's where the leverage comes in. Now imagine the stock climbs to $130. David's option gives him the right to buy at $100. The market says those shares are worth $130. That's a $30 difference across 100 shares, $3,000 of value. Subtract his original $200 premium, and David has a potential $2,800 gain before fees and other considerations. That's the raw power of leverage. A relatively small amount of capital can control a much larger position. But now let's change the story. The stock doesn't rise. It barely moves. 30 days pass. The stock is sitting at $98. David's option is no longer useful. Why would he pay $100 through his contract when the market is offering the stock for $98? He wouldn't. He lets the option expire worthless. His loss is limited to the $200 he paid. Now imagine the stock crashes to $50. For David, the result is essentially the same as an option buyer. His maximum loss is generally the $200 premium. That sounds attractive, and that's exactly why so many beginners become interested in options. But here's the question most people forget to ask. Who is standing on the other side of the trade? Every time David buys an option, someone else is selling it. Let's call her Sarah. Sarah receives David's $200, but she isn't necessarily just gambling against him. She could be part of a market-making or institutional operation designed to provide liquidity and manage risk. Her position is fundamentally different from David's. If the stock stays flat or falls, the option may expire worthless, and the premium can become part of the seller's profit. But if the stock surges dramatically, the seller can face significant losses depending on the strategy and how the position is hedged. David's position is essentially the mirror image. He pays a known amount up front for a contract that may become much more valuable. Sarah receives that payment and takes on the obligation associated with selling the contract. And this is where options get interesting, because the stock price isn't the only thing affecting that contract. There are several invisible forces working underneath it, and 3 of them matter enormously. The first is the relationship between the stock price and the strike price. The second is time decay, and the third is implied volatility. Let's start with the first. Suppose David buys a $100 strike call for $2 per share. Because one contract represents 100 shares, that costs him $200. Now imagine the stock reaches $101. Technically, his option is in the money, but David hasn't necessarily made money. The option has only $1 per share of intrinsic value. Across 100 shares, that's $100. But David paid $200 for the contract. So if the option reaches expiration at $101, David is still down about $100 before fees. That's why being right about direction isn't enough. The stock needs to move far enough to overcome the premium. For a basic call held to expiration, the break-even price is the strike price plus premium paid. So in this example, $100 plus $2 equals a $102 break-even price. Anything below that at expiration produces a net loss for the buyer. And this is one of the first psychological traps. You look at the stock and see it going up. You think, I'm right. But the option is asking a different question. Did it go up enough? Now we reach the second force, and this one works silently. Time decay. When you buy an option, you're not just buying direction, you're buying direction with a deadline. Every option has an expiration date, and every day that passes removes some of the time available for your prediction to work. Think about an ice cube sitting on a warm counter. You don't have to touch it, you don't have to push it. Time does the work for you. Eventually, the ice disappears. Options aren't literally melting, of course, but the time value embedded in an option generally declines as expiration approaches. This is known as theta, or time decay, and it can become especially important as expiration gets closer. Imagine David buys a short-term call because he believes a technology company is about to rally, but the stock stays almost completely flat for 2 weeks. His prediction hasn't necessarily been proven wrong. The company hasn't collapsed. The stock hasn't even moved dramatically against him. But the clock has been moving every single day, and the amount of time left for the trade to work keeps shrinking. This is why someone can correctly predict the direction of a stock and still lose money. They weren't necessarily wrong about the company, they were wrong about the timing, and timing is everything when you're buying an option with an expiration date. But there's still one more force, and this one can surprise even experienced traders: implied volatility. Option prices don't only react to the stock's current price, they also reflect how much movement the market expects in the future. When uncertainty rises, option premiums can become more expensive. Think about insurance. If a hurricane is approaching, people suddenly become much more interested in protection. The price of that protection can rise. Options can behave similarly. Before major events such as earnings announcements, investors often expect unusually large price movement. That expectation can increase implied volatility, and higher implied volatility can make options more expensive. But then the event happens, the uncertainty disappears, and implied volatility can fall sharply. That's where something called volatility crush can occur. Imagine David buys a call right before an earnings announcement. The company reports strong results. The stock jumps 2%. David was right, but the option he purchased was priced with a high level of expected volatility. After the announcement, that uncertainty disappears. The volatility component of the option's value can fall, and suddenly David's option may not gain as much as he expected, or even lose value depending on the size of the stock move and the change in volatility. That's the strange part. The stock can move in your predicted direction, and your option can still disappoint you. Because you weren't only betting on direction, you were also paying for time, and you were paying for expected movement. That's the deeper reality of options. An option isn't simply a leveraged version of owning stock. It's a contract whose value is influenced by several variables at the same time: price, time, volatility, and the relationship between the stock and the strike price. That's why options can feel so strange to beginners. You look at the stock and think, "I'm right." But the options market is asking, were you right enough, quickly enough, under the conditions you paid for? That's a completely different question. And there's another misconception worth clearing up. Many beginners imagine that options traders simply hold contracts until expiration and then take delivery of shares. But traders can also close their positions before expiration by selling the option itself. Think of it like a concert ticket. You buy a ticket for $100. Then the artist suddenly becomes incredibly popular. Someone else is willing to pay $600 for that ticket. You don't necessarily have to attend the concert. You can sell the ticket. Options can work similarly. The contract itself can become more or less valuable before expiration, and traders can buy and sell those contracts to close positions. That's why options are better understood as contracts for transferring and managing risk rather than lottery tickets. They can be used for speculation. They can be used for hedging. They can be used in strategies such as covered calls, but none of that changes the underlying reality. Leverage magnifies outcomes, and complexity creates opportunities for mistakes. So if you're learning options, don't start with the question, how much money can I make? Start with, what exactly has to happen for this trade to work? How far does the stock have to move? How much time do you have? How much premium are you paying? What happens if volatility falls? And most importantly, what happens if your prediction is correct, but the move comes too late? That question alone can change the way you look at options. Because options aren't dangerous simply because they're complicated. They're dangerous when people treat a complicated financial instrument like a simple bet. The smartest trader isn't necessarily the person who predicts the stock correctly. It's the person who understands what the contract is actually pricing. And now you know the three invisible forces hiding inside that $200 trade: the distance from the strike, time decay, and implied volatility. Once you understand those three, the mystery starts to disappear, and that's when you finally see what leverage really is. Not free money, not a Wall Street loophole, just a financial tool where being right isn't always enough. Sometimes you have to be right at the right price, at the right time, under the right conditions. And that's what makes options so powerful and so unforgiving.